All right. Welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker MSFT, Microsoft. Hopefully we can get going a little bit quicker this time. Had some technical difficulties a few minutes ago. Kind of had some issues with the audio, but a viewer pointed out pretty quickly, so we managed to get the stream down and back up relatively quickly. But excited to get going with the actual valuation. Before we do actually get into Microsoft specifically, taking a look at our watch list. I had kind of already said it, but I'll kind of say it again. This week I made some more purchases in Interfor, as well as Buckle and Smith & Wesson. So buying up here near the top of our list, which is companies that we own. We've managed to consolidate a lot of our positions, getting rid of some weaker positions that we have less confidence in, while trying to concentrate into newer and more confident positions that we've had that have the best valuations that we think are available. So doing some pretty good moving there. Also changing around some of the more macro based positions I have in my portfolio, because really about like 80% of my portfolio is in normal stock positions, and then I do have about 10 to 15% usually at any given time kind of in some alternative assets of varying kinds, kind of shifting around some stuff in there as well. But either way, it's been a pretty good rearrangement of our portfolio in the last month or two. There was a new report, the JOLTS report, the job openings and labor turnover report that came out today. I haven't actually had a chance to go look into it specifically, but the market seems to be kind of in a little bit of middling territory, so it doesn't look like it was at least a disaster, but like I said, I say that without actually having looked at it. It's just taking it based off of the market's reaction. Very interesting seeing the market's reaction to the Federal Reserve announcement, for example. The market's been relatively calm, in my opinion, and the bond markets have been reacting a little bit interestingly as well. The rates are not going up the way that one might expect with the upward movement in interest rates. The bond market's really starting to price in negative economy and the expectations that the bond market will go the other way. I'm pretty on the table as far as which direction I think everything's going to go in the end of it, but either way, I digress from that. So as we had been kind of saying for the last several of our evaluations, we have been saying that Alibaba, Microsoft, and Sandfire Resources were the three that we were waiting for. Obviously, we've made it through Alibaba and Microsoft now with this valuation we're doing today. And I've seen, obviously, there was a very strong reaction with my Alibaba valuation. We got some very good views on that relative to some of our other valuations, and a decent handful of new subscribers. So if you're new to the channel, thank you for showing up. And by the way, if you're watching, please give us a like. It'd be very, very appreciated. More likes attracts more people to the channel, and then we can get more subscribers, and then that just makes our community even bigger. And also, if you are new to the channel, you might also like to know that we have a Discord. You can find the link in the description below, where we have discussions about the daily news, discussions about all sorts of stuff, sharing funny memes, our portfolios, company analysis, and discussions about major investors and things like that. So join that in the link in the description below. So getting into actually Microsoft specifically, we'll do some basic coverage of basic company information. Microsoft was founded in 1975. It is obviously incorporated in the United States on the NASDAQ exchange. Its main currency of operations is the United States dollar, as should be obviously expected. We do have its listed at three major websites that are relevant to finding information about it. Its main website, Investor Relations, and the SEC page. Its current CEO, Satya Nadella, was elected as CEO in 2014. He did, however, join Microsoft in 1992, and if I'm not mistaken, he was previously working, was it in Starbucks? Oh, no, my bad. No, he's currently also on the board of Starbucks. My bad. I can't remember actually where he came from off the top of my head right now. But either way, main industry that Microsoft operates in is systematic and application software. Obviously, software as a service. Lots of different subcategories of businesses that they operate in, but that's basically the main categories of it. They have three main segments that people generally talk about, which they have the productivity segment, as well as their cloud segment, and the the cloud and personal computing. That's right, more personal computing. I always get confused because I kind of want to combine the first and three together in weird ways, because they have some overlap. One's more the consumer focus, one's more the business focus, but either way, I digress. So they do have, I do have their OEMs that they list here, which is sort of like their major customers, because they actually have a lot of customers. But these are the original operating manufacturers that their software goes inside that are the most relevant to them: Dell, HP, and Lenovo. So you can think of those as major customers of theirs that is particularly important to thinking about future revenues of theirs, as far as where a large amount of growth for certain parts of the segment comes from. And then competitors, well, since they operate in several different segments of business, you can kind of think about their competitors as being pretty diverse. But they list major competitors within the business overview section of their 10K, listing Apple, Cisco, Google, IBM, Amazon, Oracle, as various aspects of the enterprise software industry. And the suppliers, I didn't really list that here, since they're primarily software themselves. They're not really prone to reliance on suppliers per se. So a report date, obviously these report dates were listed here. I had typed this in here prior to their actual calls that they came in. So obviously that information is already passed. I don't have the next ones up here currently. The revenue guidance that we have right here, this was actually the estimate of the revenue guidance for the 2022 numbers, which obviously we just already got. So I don't actually have the guidance for 2023. I don't think that they actually provided it. If I recall, they didn't really provide guidance for the first one. They're going to provide it on the first quarter call, I believe, or maybe they won't at all. But there is the revenue estimates that the analysts have made on Yahoo. 33 analysts are said to have 14.3% as the midpoint of the expectations for the 2023 numbers, with earnings from those same analysts, about 43 of them, for an adjusted EPS of $10.69 per share. The trailing dividend is $2.42 per share, with a forward dividend, because they already had announced an increase, to $2.48 per share, which comes out to just below 1% for a forward dividend rate. And they do have $48.5 billion of buyback authorized currently left over, which equates to 2.34. So, I mean, between the two of them together, if they had used that buyback in 1 year, that would equate to a yield of 3.24% or so. Again, assuming they did all the buyback in 1 year. A relatively minuscule amount of insiders holding shares here, so nothing to note on as far as that goes. There has been a slight increase in the inside ownership in the last 6 months, but again, relative to what? It's basically nothing. 71 to 72% of the companies held by large major institutions. So yeah, majorly a pretty large major institution holding, which makes sense considering they're one of the largest companies. That should just be obvious. But also because of their scale, it makes it incredibly hard to short them in any sort of sense of proportion or ratio. So their percent short is basically minuscule as well, a pretty minuscule short ratio as well. 3-month average volume, 31 million shares being traded over per day. The 10-day average volume being 25 million, so it's been a little bit short, obviously, in the last couple of weeks relative to the last 3 months or so. So before getting into the financial numbers for the company, we do want to take a look a little bit at some of the slides that they provided with their fourth quarter call that they have right here. Taking a look at the Q4 summary, obviously they have right here, they have their 3 major segments that I mentioned here: the productivity and business processes, intelligent cloud, more personal computing. You can see that the growth between the 3 segments and how that they differ: more personal computing being pretty mature form of business. This is the part that's very reliant on the OEMs. Well, actually both these are reliant on OEMs in different ways. And in some ways it's like half of this is reliant on OEMs and maybe 2/3 of this is reliant on OEMs. But since this is going to be reliant on OEMs, it's going to be a little bit more mature, focus on the consumer growth of the main section of the economy, while productivity and business processes, like I said, about half of that's going to have a similar profile, but then there's going to be other aspects where they're shifting into the software as a service, which gives them a larger segment of growth. So you can see 2% here versus 13% here. And then intelligent cloud ending up at 20%, which is obviously the big growth engine, shifting into AI with Azure and SQL. Obviously, you can take a look at the constant currency growth. You can see obviously it's a lot stronger because they operate pretty significantly outside the United States, and currencies outside of the United States have done relatively poorly in the last 12 months or so, especially in the last 6 months or so. And that, whether or not that reverses or not, that's the reason why people tend to look at constant currency growth, is because it's based off of the idea that, oh well, the currencies will reverse at some point, and so all of that will end up flattening out itself over time. And so we'd much rather focus on like what the actual operational growth is. I don't actually necessarily buy that personally, because that would make sense if you weren't shifting your business mix the whole time. If you kept the same business mix in the same geographies at the same time, and then the reversion to mean happened with the currencies, then I could buy that argument. But since there's so many caveats to that, I personally just like to look at growth as it is and then take the currency differences as part of the operational expenses. That's just my personal way of thinking about it. So personally, I'm focusing on these growth rates myself. So we will break it down a little bit. Oh, actually, before breaking it down into the subsections, I forgot they had this slide. This slide is actually pretty neat because it kind of shows the way that they had their guidance evolve throughout the year. They had their initial guidance for the different segments, and then showing how the FX had impacted throughout May, and then they revised their guidance accordingly with that. And then they revised their guidance again a couple months later, getting to an adjusted guidance range, and then showing how their gap results actually reflected within that. I wish more companies did something like this, where they actually showed their guidance and like how they did relative to their guidance, and not only just where their guidance ended up, but also showing how their guidance shifted over the course of a year. Because that's just something neat that a lot of companies don't necessarily do. Microsoft is pretty good at presenting a lot of its information in a very friendly way. In this slide right here, they do talk about like how it is that they managed to miss their guidance in various ways, because it is worth noting. Anybody that was paying attention might have noticed that they did in fact miss their guidance, miss their higher end of the range of the guidance, and they were on the lower end of it, so they had to make explanations exactly like why the FX shifts happened over the course of the year. And they talk about it here: unfavorable foreign exchange rate movements within the quarter negatively impacted revenue and diluted earnings per share. Extended production shutdowns in China that continued through May, a deteriorating PC market in June contributed to negative impact on Windows OEM revenue of over negative 300 million. And then reductions in advertising spend contributed to a negative impact on LinkedIn, as well as search and news advertising revenue of over negative 100 million. So it's interesting to show how they talk about how reductions in their advertising expenditures led to a decline in their revenue. So you might think, oh, well, they're reducing their expenditures. That means they're making themselves more profitable. Not necessarily. So this is the thing where things get a little more complicated, where things that are thought of as expenses might actually be a form of capital growth in different ways of thinking about it. I haven't really done that too much with my forms of valuation. I have done it with R&D expenses. Anybody who's watched my channel for any length of time knows that I take R&D expenses and I capitalize it onto the balance sheet and treat it as an asset that has to be amortized out over time, which has the effect of increasing your margins, assuming you keep doing the R&D, as well as decreasing your returns on invested capital as you increase the capital base. But you can do the same thing with advertising costs for a company that is so heavily reliant on the advertising for growth. I wouldn't necessarily do this for all the advertising costs of Microsoft, because they're much more of a technology focused company. But if you were to narrow in on sections of their company that is very focused on building up of a user base, as well as a client asset relationship, then you could maybe argue that things like LinkedIn, as well as the Teams part of their business, would be very heavily reliant on that, and you could treat advertising and other marketing costs as a form of capital rather than a operational expense. So for example, if you were doing a valuation of Coca-Cola, you might take all their advertising costs and turn that into an asset on their balance sheet and treat that as like its brand name on the balance sheet. I digress with that concept. I'm not actually going to do that with the valuation because it's such a narrow part of their business, but just an interesting concept I want to point out here. They basically said it in direct words, that reductions in advertising spend contribute to a negative impact on the revenue, which is just an interesting way to think about a decrease in operating expenses, decrease their revenue. Anyway, so continuing on with the ongoing war in Ukraine, we made a decision to significantly scale down operations in Russia, blah, 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 blah. Every company in the world is basically done on that, so they had to take some hits there as well. Moving on to what I was actually going to say, is that they do actually show the different subsections of their business: the productivity, intelligent cloud, and personal computing. They do narrow it in quarter by quarter, as well as the subsections of each individual part of the business. You can see here productivity and business processes, office, commercial, and 360. The more mature parts, they're still in the teens, but still a little more mature parts of it, versus dynamic cloud services, as well as the LinkedIn revenue being the more robust upper revenue growth rates you can see right here. But you can still see the shift down throughout 2021 into the later quarters of 2022, shifting from the 20s and down to 18 to 14 to 12 to 9. You can see a consistent downward trend as far as that goes. But you can see the same thing for like LinkedIn, 46 to 42 to 37 to 34 to 26, a pretty consistent downward shift in the revenue year over year number. Shifting along from productivity and business to intelligent cloud, you can sort of see a similar trend, but a little bit slower. 34, 35 moved upward a little bit there, 29, 29, 22. So a little bit more of a chaotic downward movement, but a very significant downward shift from these upper 30s into, or mid 30s, I guess I should say, into lower 20s as far as the intelligent cloud growth. So we got to think about that. That's the growth engine of the company. but its growth is slowing down pretty dramatically. And then shifting from cloud into more personal computing, you can see a Windows OEM growth from -3 to 10 to 25 to 11 to -2. So this one, you can argue, is dealing with some of the inflationary expenses, as the Windows OEM is revenues can be affected by the OEM operational costs of the OEMs themselves. And you can see that the biggest burst of it comes in Q1, Q2, Q3, and then it's moving in the downward shift from there, which most of the inflationary pressure was starting to hit in this kind of section right here. As far as the biggest year-over-year shifts so far in the CPI, we'll see where things go from there, but I digress. So that's going to basically do it as far as our look into the operational segments of their business. Like I said, I thought their PowerPoint was really good as far as trying to break down their business into different subsections. As far as my projections for the company, I'm really taking a pretty broad top-down look at the company, and I'm not actually making projections based off of different subsections of the business. We're really just making a pretty broad overview as far as like what revenue growth I think they can achieve. But that's kind of why I wanted to look at the slides to get an idea of like how their businesses grow individually from each other, so we can really just make a pretty simple claim as far as like what we think they're going to achieve on average overall. But as far as taking a look at that, you can see is their segments, productivity and business processes are 32% of the business, while intelligent cloud is 37-38%, and more personal computing is at 30%. So you can see intelligent cloud is already the lion's share of their business, and it's the fastest growing portion of their business. So that's pretty good. That means that if maybe over 5 more years that this grew at the same consistent rate that it's already growing at, this grew at the same consistent rate it's already growing at, and this one was, it's barely growing at all, then I could easily see this becoming like 50% of their business, while this perhaps becomes like 35%. Well, I'm at 35%. This can say maybe around 30% of their business, and then this shifts maybe down to 20% of their business or something like that. That would give us 100%. So I think that could work out, maybe like 50, 30, 20, something like that in the overall mix as far as that goes. And then that's worth noting because that thinks about how the unlevered beta can shift over time. I didn't add that into the projections, but that's worth noting that this is the highest beta, at least in this particular year. So you could think about maybe that's relevant to the risk of this more mature aspect of the business. And it could be arguable that if this is going to be shifted down by about a third over time, then this is going to shift this number downward over time. This is also the smallest number of the 3 here. So if this is going to become a bigger part of the business, the beta in here is going to become lower over time. But either way, unlevered beta I end up with as a product of the business mix is 1.23. The sales capital expectations I end up with 1.93 with an adjusted net margin of 17.67. With this form of mix that I created for here, it's much more relevant for the unlevered beta and isn't quite as relevant for the sales capital ratio and the adjusted net margin assumptions. Similar to what I did with Alibaba, it just kind of comes down to like how you're doing it, but I did it based more on their business mix than based off of their competitors that is in the actual index with them. So that's just a different way of doing it. Coming down to the geographic disbursement of their revenues, you can see 50% of the revenues comes from the United States, with about 50% coming from outside the United States. 64% of their major long-term assets are in the United States, with about 9% in Ireland and 26 to 27% everywhere else. So we end up with an adjusted ERP for the company after updating it fully to 5.81, with their debt to equity ratio of 2 to 3%, so basically no major amounts of debt. That brings the unlevered beta up to 1.26, which brings the cost of equity to 10.07. So a pretty decent cost of equity, not too dramatic, but a pretty healthy, significant amount. That does come off of the debt levels that they have, which is after adjusting for lease liabilities as well, $55.5 billion currently at a weighted average maturity of 22 years and an interest rate of 3.31%. So whether that's going to go over time is a big question. I do have my projections shifting it upward pretty significantly over time, but that's partially off the back that I do find them to be a bit overvalued. So I see the market cap adjusting significantly, and then not to mention I can see them issuing more debt in the next year or two, possibly, depending on issues and in their business. We'll get into that. So we will get into the kind of financial history of the company, taking a look at the 10 years that I have of their financial history here. In 2012, actually before getting into that, if you're watching up to this point, it'd be really appreciated if you could give us a like. Please, if you are not already subscribed to the channel, please subscribe to the channel. And if you have done both of those things, join the Discord. You can find the link in the description below. But especially give us those likes. We'd be really appreciated. It helps attract more viewers to the channel, and it's the thing that YouTube likes the most for doing so. So in 2012, they had sales of $77.8 billion. And in 2021, they had sales of $198.2 billion. So very, very dramatic growth in sales over the 10-year period. You can see that over the first 5-year period, they had a kind of a rolling growth of about 7% per year. And that's pretty consistent with getting close to the point where they started shifting much more dramatically to the software as a service. I think that began much more at the start of Satya Nadella's reign, so more like 2015, 2016. But either way, it kind of gives us an idea of showing how they shifted from relying on getting their software put in the OEMs in a much more consistent way. So a little bit more, still pretty good growth for such a mature company, but it was a little bit more chaotic and not as consistent. For example, you can see they even had negative number in 2015. But ever since they shifted into the software as a service model, they've gotten not only more consistent revenues, but shifted much more into stronger growth in the teens. 14% in 2017, 14% in 2018, 13 to 14% in 2019, 17.5% in 2020, and then almost 18% in 2021. So yeah, the revenues have just been pretty insane. So going from 7% revenue growth in the first 5 years of our historic period to then 15% in the next 5 years, that's insane to have accelerated in such a dramatic way. And now taking a look at the gross margins, you can see the gross margins for the first 5 years on average came in at 67%. They did have stronger margins in 2012 of 73, 74%, pretty significantly stronger, but that could just be a fluke year. I don't have the 2011 numbers right here to double check with that, but 67%, you can see that you could argue that that's a downward trend between the 5-year period, but then it does start to at least reverse course over that period right there. So from 67% for the first 5 years, it averaged 67% also in this next 5 years. So basically, actually overall, with the ebb and flow in the 10-year period, it's basically been a pretty consistent gross margin, even though their business had shifted, as I was saying before, which is pretty interesting to see that the gross margin part didn't actually shift all that much. Taking a look at their operating margins, you can see that did have a little bit of an ebb and flow as well, with the first 5 years averaging 31.5%, and then the next 5 years averaging 37%. So the operating margins have grown pretty significantly with the revenue growth, which is good because with that type of strong teens growth, you would hope that the operating margins would be growing as well. And then coming down to the reported net margins, you can see how that shifted over time. For the first 5 years, they had 23%, and that did have a little bit of ups and downs, 13% being the kind of the low end of that. The average, and then the high end being 28%. So 23% as a strong average, pretty either way. And then the next 5 years, it moves upward to about 30%. 30% with the lower point being 15% at the start and 36% right there. So 30%, 23%, looking at the average over the whole range of it, ends up being 26 to 27% for the reported net income margin. However, as I was saying before, we like to adjust our margins for our R&D capitalization, which gives us only 5 to 6 years of accurate numbers, unfortunately, due to the way R&D capitalizes in this balance sheet. So really just kind of looking at that whole average period, we end up with 32 to 33%, versus if we look at the same years on the reported net margin, we have 29.4%. So you can see that by capitalizing R&D, we can see that their margins are actually 2 to 3% higher on average over the last 6 years. If we maybe take a look at the most recent 3 years, just to compare that's 38.3% when it's corrected, versus 34.7. So that's actually maybe about 4% difference in the most recent 3 years as well. So just to get an idea about how R&D capitalization can work. Moving down the line to the free cash flow to equities, we can see that for the first 5 years of the historic period, they had $29.5 billion in cash flows that they could have paid out to their shareholders per year on average. And the amount that they did pay out to their shareholders was $20 billion. So definitely not overpaying their shareholders, but still paying out pretty significant amounts, paying out about 2/3 of what they could have paid out. In the next 5 years, they had an average of $32.6 billion. So a growth in their cash flows, and but still, how much did they pay out in this particular 5-year period? Comes out to $36.5 billion. So for the last 5 years, they've technically overpaid their shareholders the amount that they arguably could have paid out to their shareholders. If we take a look at the average for the full 10-year period, it comes out to $31 billion that they could have paid out, and the total amount that they did pay out is $28.3 billion. So while they have overpaid their shareholders for the last 5 years, you could argue that they were just making up for the fact that they had underpaid in the 5 years previously before that. And then also something that we've kind of generally talked about before is that the balance sheet makes a big statement as far as that goes, which we'll get into in a minute. Returns on invested capital, we can see the returns on invested capital for the first 5 years averaged about 20% on any given year, and the last 5 years it's also averaged about 20%. So it's been a pretty consistent trend as far as the returns on invested capital go, even though they've moved up and down and around. You can see for the first couple of years it does have pretty high levels of 20s and even into the 30s right there, and then it went down into the teens, almost going down into the single digits, but it still stayed above 10% right here. And then in the last few years it's shot back up in the 20s and getting close to the 30%, partially off of the back of the huge amounts of share buybacks that were done in the last 5 years. It's worth noting because it does shrink the capital base. So they've been shrinking their capital base while their returns have been increasing. So you could also argue that the R&D capitalization has an effect on this aspect as well. So if we just take a look, for example, of the last 6 years, it comes out to 19.6%. And if we just compare the first 3, which is 14.6%, to the next 3, which is 24.5%, so you can see that the growth is pretty consistent if we're only looking at those 6 years. Although admittedly, that's where all the growth was occurring in the revenues. So we can maybe use the 5-year average as a better baseline of what's happened in the last most recent past or so. So coming down to the balance sheet, you can take a look at what I was kind of talking about as far as thinking about whether or not a company has overpaid the shareholders. Is another way to take a look at it, is to see whether or not where that would show up on the balance sheet. That being, for example, the cash and equivalents. Them going from 3.8 billion in the first year, and then averaging about 6.4 billion over the first 5 years, to 13.9 billion and averaging about 13 billion or so over the last 5 years. So they've grown their cash balances actually pretty dramatically, basically tripling it. And they've also have huge amounts of marketable securities that they've generally had on hand at any given time, which are pretty close to cash. I mean, you want to discount it a little bit, generally speaking, or at least that's my opinion. But it is worth noting that that's been a little bit more of a chaotic trend as far as how much they've had on hand. You can see they went from 72.6, but it shot up to 125 billion or so in 2016. So the average for the first 5 years is 94 billion. And then it's actually trended downward for the last 5 years or so. So it's still been on a little bit of an upward trend over the entire 10-year period, but it's been a little bit of an ebb and flow as far as how much they've held in terms of marketable securities. Though it is worth noting that I see it as them it looks almost like they were increasing the marketable securities as the interest rates were going up in the previous hiking cycle a bit, and then they started to bring it back down a little bit. Oh, here, just give me a second. I hear my cat crying outside. Bring him inside. One moment. All right, I'm back. All right, so also moving down from just the marketable securities and the cash, we can take a look at the overall amounts of their current assets. That has increased pretty significantly over the 10-year period, but that also basically shot up more dramatically in the first 5 years, as we can see right here, peaking actually in 2017, and then not peaking in 2017, it actually came up to the level we're currently at in 2017. It actually peaked in 2019, and then it's come back down, like I said, to that 2017 level. So up still pretty significantly, but it's had a little bit more of an ebb and flow when it takes into account all the other factors. So moving down the line to balance that out with the current liabilities, however, very, very small amounts of current liabilities, relatively speaking. 37.4 billion at the start of the period, averaging about 49.5 billion for the first 5 years, and then averaging 76.7 billion in the next 5 years. So averaging 76.5 billion versus the average assets of 176.2. They've had more than double, almost 2.5 times of current assets versus current liabilities for the last 5 years, and then that trend is consistent with the current numbers as well. So always having huge amounts of assets on hand. Long-term debt pretty minuscule relative to the overall market cap. We had already talked about that at the start, with their debt to equity ratio being like 2 to 3%. So very, very strong balance sheet. As we said before, that their overpayment in the last 5 years, you can basically easily hand wave that away with the growth of their assets in general. And then on the backs of that, you can also take a look at the other factor I generally like to back that up with, is the retained earnings as well as the shareholders' equity. Shareholders' equity has more than doubled over the last 10-year period. It basically was flat for the first 5 years, relatively speaking, and then it's moved up in the last 5 years, which is interesting because that's where the large amounts of the payments were. It was in the last 5 years, and even then, that's where the shareholders' equity actually was doing most of the work. The retained earnings was doing some significant work all throughout the period, but it had a little bit more of a chaotic movement up and down. But either way, moving from about 10 billion or so to 84 billion in retained earnings or so. So by no means can you really argue they're truly overpaying once you take the balance sheet into account. So moving down the line, we can also take a look at where they've traded relative to their earnings. The PE ratio for the first 5 years of their business, or you can also think of this as prior to them doing the shift in their business mix. They averaged about a PE ratio of 19. And then versus the PE ratio that they've had ever since doing their business mix, they've then had an average PE of 30. So obviously that had a huge dramatic shift in the way the market was pricing their company, partially off of the back of expected growth, naturally speaking, because that's generally where PE ratios tend to come from. Obviously, it has shifted a bit back downward from those 30 points that's currently being at 28. And that doesn't take R&D capitalization into account, which we can do with the PE ratio as well. So if I'm really just trying to think about like the most recent few years, which we know are the accurate numbers, then even so, the 2016 through 2018 average PE was 23 versus the next 3 years after that, it averaged 27. So you can see that even just with the limited amount of data we have, the R&D capitalized years, you can still see a significant shift upward in the pricing of the market in the last 3 years versus the 3 years prior to that. But even so, that 27 of the last 3 years is the average. We're still down to 25.85 in the most recent current trading period. So either way, the market is still bringing even the high and mighty Microsoft down a little bit, but it's still trading at 25, even with the interest rate expectations as it currently is. Now we can also take a look at the sales capital ratio, which is my proxy for thinking about how much reinvestment needs to be done in the business to achieve the growth. You can see for the first 5 years of the business, they averaged about 0.63, which is 64 cents for every dollar invested, 64 cents in revenue for every dollar invested in the business itself. And then for the next 5 years, as an average, we got 60 to 61. So it's actually been a little bit of a downward shift in the sales capital ratio in order to achieve those higher margins and higher revenue growth rates, which makes sense. You can't get everything generally for free. So they have to huge amounts of capital into the business in order to eke out the revenue growth and the margin growth that they've got. But honestly, that's a pretty small downward shift in sales capital ratio, relatively speaking, in order to achieve that. But it is worth noting that that's what it costs, is keeping the sales capital ratio relatively low, getting only 60 cents on the dollar for every capital invested in the business in revenues. And then off of those 60 cents of revenues you get, you then manage to keep about 30 to 40% of it, which means you're keeping about 20 cents, which means out of every dollar invested in the business, you're going to get about 20 cents in profit. What does that sound like to me? That sounds like 20% return on invested capital. Either way, it sounds like a good business. You can see how that works out. So we will come over here and take a look at the projections I put in line for the company. I'll start with the debt to equity ratio, since we're kind of already down here and it's some of the least important and significant factors. As we've seen before, it's already trading at 2.67%. So it's worth noting that I'm actually shifting it upward pretty significantly to 6.75%. And that's actually me doing them a little bit of a favor, because that means that the capital, that very expensive capital that I was just talking about, becomes a little bit less expensive for them overall. Hey Jack, what's up? I haven't seen you in chat for a long time, though obviously seen you a little bit here and there in the Discord. So with that, I do have, like I said, the worst case scenario expected 15% versus 0% on the best case scenario. On expected ratio, it comes out to 6.75%. This is me basically assuming that the market cap readjusts accordingly with my expectations here. But even so, I'm assuming that they basically double their debt, 2.5 times their debt in the next 5 years, which, as I said, that might sound like it's actually punishing them because of the interest cost, but because of how little debt they already have, in some ways it actually benefits them because of their low sales capital ratio. As far as the sales capital ratio expectations, the worst case scenario, I have a 0.35 shifting upward to best case scenario of 0.95, leaning towards 0.75, which gets me an expected range of 0.84. This is another area where I'm actually being very beneficial to them. As I was just saying before, as they've shifted into the more software AI focused parts of their business, it's actually made their sales capital ratio trend downward over time, not upward. So by allowing the next 5 years me to have their sales capital ratio shift back upward, I'm actually saying that they're basically going to get the fruits of all the labor they did in the last 5 years, and that's going to start to benefit them in ways that they were never had before. So that's actually one major benefit I've given them in this valuation, where they otherwise should have a much lower valuation. It's worth noting. Before moving on to the other factors. Then moving on to the revenue growth, which in some ways is one of the most important factors to understand here. Now, as I had said before, I didn't actually do a very segment focused specific a revenue growth pattern to figure out like which I thought each of the three businesses could end up being versus each other. I kind of just took a top-down approach. Jack, curious about something here. Your bottom line on Microsoft has around 35 billion profit and a value score price of 86, which is $660 billion. Whoa, what? What do you mean? The bottom line of your last bottom line on MSFT has around 35 billion profit and the value score price of $86. I mean, I don't necessarily want to talk about the final parts at that moment. I'm trying to finish up there, but I don't know. Maybe I'll talk about it. I'm trying to figure out what you're saying. A $35 billion profit and value score price of which is 660 billion valuation. The bottom line on your last valuation, Bob, was 12 billion profit, around 33 billion valuation at $10 share. So I'm not really sure what you're saying, man. And if you're looking at the profit number here, I hope you're not making too bold of assumptions about like where that like a ratio based off of this, because you have to take into account that this is the earnings number, but this isn't the cash flow number. So I'm not sure if you're making an assumption based off of like where it should be trading on a ratio basis or something like that, because that's where the sales to capital ratio part comes into mind, because this is pre capital expenditures. This is effectively net income, adjusted net income. It's the R&D adjusted net income number. Yeah, so I mean, we would have to do some other factors in here, because this is the net income, but it doesn't take into account the fact that I'm assuming that they have really bad capital expenditures to do in this worst case scenario. It's a very worst case scenario, which is why it's only 5% in the first place. So if that's, so it's like if you're thinking like in this scenario right here, if you see a $35 billion profit here, that would be their net income, but like they would probably have like operating profits of more like 10 to 15 billion in that scenario. You know, they would be having, they would not, or not operating profits, more like free cash flow of 10 to 15 billion in that scenario. They would have, the 35 billion would be roughly close to their operating cash flows, but then after dealing with capital expenditures, they would still have much lower numbers. That's kind of where that situation comes into play. It has to do also with the discounting as well, because with the worst case scenario, that gets them the 15% debt to equity ratio, and so that increases the discount rate into their worst case scenario discount rate, which admittedly for them is not that much higher, so that's not necessarily going to have that big of an effect on Microsoft, but that would have a much bigger effect on Alibaba, for example. So because you gotta keep in mind, I'm not doing these things based off of multiples, I'm doing these things based off of discount rates, which are related to each other, but kind of tricky to see the differences. Well, BABA in the same worst case scenario was also 0.35 sales to capital ratio and 15% debt to equity ratio. I guess I'm just curious how your model gave this a 20 XPE in the worst case, and BABA got 3x. Well, like I said, I'd have to break down all the numbers and try to turn it into a PE ratio example, which I can do for you maybe outside of the stream, but I can talk to you after the stream and try to figure that out. But it's a little bit tricky to think about converting it right now in this method. Here, I'll talk to you after the stream about that. Anyway, let me continue with the actual stream that I'm in. So the revenue assumptions, like I said, I'm going to, like I said, I'm more than happy to get into it with you after the stream though, because it relates to just the factors related to it, because this is not, like I said, it's not the cash flow number that goes into it. So this $35 billion line right here is the year 5 net income, which is over here. But if you come down the line in that same year, I'm assuming that they have massive amounts of reinvestment, and then I would have to pull up in the Alibaba valuation to show you what the differences in that reinvestment comes down to, because it also comes down to what their current amount of reinvestment that they already had was in the first place. Because if they already have a larger capital base relative to their sales and their profits, which they're not going to have the same ratios, like my assumptions on the worst case scenarios for those two valuations might be the same, but the starting point for each of them is not the same. So it's not going to give you the same results in the first place. So it's like I'd have to break down all the numbers specifically, which, like I said, I'll try to figure that out and discuss that with you. But anyway, getting back to Microsoft. So for the first year of the revenue baseline, I'm going to use the 2-year average of their most recent revenues as my baseline. That's going to simulate a little bit of slower growth in the next year, which is in line with what the company themselves is projected, as well as what a lot of the analysts are projecting. A lot of analysts are projecting around 11% for the next year, and then going into more like 13 to 14% in the year after that. So I'm basically kind of in line with that, but I'm assuming more like 9 to 10% for the next year as an expected ratio. And then I have it shifting more upward towards 17% on expected basis over the entire 5-year period. So I do see them re-accelerating after the next year or so, but I do think it's going to actually possibly be a little bit higher. I'm actually trying to put this as a little bit more of an optimistic case for Microsoft. And that's worth noting too, that this valuation for Microsoft, I am trying to be somewhat more optimistic for them comparative to Alibaba, because I actually think that Microsoft is likely to outperform my expectations, just because they generally have outperformed my expectations. So there's that factor to keep in mind as well. But with the probabilities, I do have about 45% of it in the median case model, with about 20% in the more optimistic versus 10% in the less optimistic. For the net income, the adjusted net income expectations, I have the worst case scenario being 15% and the best case scenario being 50%. With the expected leaning towards 35%, and it does come out to be about 35% for the expected net margin. I'm using the 5-year average as my baseline, so I do think it's going to be a little bit lower in the next most recent year, about 34%. And with all those assumptions together, that actually gets me projected returns on invested capital of around 29 to 30%, which in the most recent year they had 27%. So we are seeing the returns on invested capital increase for them over the next 5 years or so, relatively speaking. And again, they had 27% in the most recent year, but about 20%, 21% for the 5 years as an average. So we're saying that they're basically going to become even more profitable in the next 5 years than they've been in the last 5 years, which, I mean, I don't think that's a unpopular opinion per se. And I don't mean just in dollar terms, I mean in percentages terms, they're going to become more profitable. And not, like I said, not even necessarily in a net margin sense, we're talking about it in a capital sense. Like I said, I think this is actually a pretty optimistic valuation for Microsoft. You could argue that this growth rate could be significantly lower. You could argue it should be more in the lower ends of the teens. You could argue that their net margin could be a little bit lower, but I actually think that's probably one of the more solid parts of the expected number. And then, as I had said before, the sales capital ratio expectations, I'm actually being pretty optimistic for them on that. I think that this number is probably the least believable part of the valuation, is that it should actually probably be a little bit lower, but I'm giving them a little bit of the benefit of the doubt here, just because they've generally done really good with their capital in the past. They might make some surprising acquisitions outside the ones that are already known on the future horizon, which are somewhat taken into account into this valuation as far as they can be. And then as far as like their debt to equity ratio, I talked about that before. I was giving them a little bit of the benefit of the doubt by pushing that up a little bit higher than it already is. They tend to be pretty hesitant to take on any more debt. So by assuming that they are going to take on debt, I'm in some ways assuming that they're going to go against what they've generally done in the past. But either way, by taking on the debt, they have basically no real default assumptions with that either. So that basically brings the total valuation together. As I've kind of been trying to point out, this is not really accurate at this point in the year. I would have to do a recorrelation to make this particular part of the box accurate. So just kind of ignore that. Saying the best case scenario is crazy here, though. Well, I mean, like I said, that would be assuming some pretty significant changes. But I mean, you know, the worst case scenario too. That's the thing. It's like you have to take the best and the worst case scenarios in line with each other. You know, they're both at 5% for a reason. It's like they're both not likely to happen. 50%, first of all, I don't think that they could achieve 50% forever. So in some ways, the valuation is a little bit flawed because of the fact that the valuation after 5 years goes into perpetuity, and so it assumes that the margins are going to go forever at 50%, and that's in some ways logically flawed. But I would say it's just as logically flawed to assume that 15% would go forever either, when they're currently already at the 35, almost 40% range. And so by assuming that they're currently at 40%, assuming that that goes up 25%, they could increase their margins by 25% to get it to 50, versus they collapse down 65 to 70% to get their margins to 15%. You know, like which one of those is more likely to happen, do you think? That they go to 50% or that they go to 15%? Because I think it's way more likely that they'd go to 50% than 15%. I don't think either is very likely at all, which is why they only get 5% chance. But it's the best and worst case scenario for a reason. You know, it's like it has to kind of take that into account as a scale of like where things can go. But admittedly, 50% and it assuming that it would go forever is a pretty absurd thing. But also the perpetuity concept in and of itself, the discounting into perpetuity concept, is also kind of a absurd concept because it doesn't actually go forever. The discounting, depending on what discount rate you use, makes the value go to zero after a certain amount of years, usually around like 20 to 30 years, depending, like I said, depending on the discount rate you use. But if you're using like a pretty typical stock discount rate, like maybe 10% or something, then yeah, really it's only like 25, 30 years or something that's actually relevant. But even then, the idea that they would hold 50% for 25 years is pretty crazy. So like I could see them getting to 50% at the 5-year period, but then it would probably be gone 5 years later after that, you know, like I don't know, something like that would maybe happen. So you could argue that this would be is more reasonable, but you could also just as easily argue that that's more reasonable, you know. And so then you kind of end up playing with these numbers and it shifts things around. I don't know, it's always a little bit of a shot in the dark when you're making the margin assumptions a lot of times with these things, but you kind of have to put a line in the sand. I'm looking more at the expected value than most other things, but yeah, this is the margins assumptions I come up with. So US Treasury selling for 2.8% or below it today. Mature market equity risk premium 5.25%. I come up to a discount rate for Microsoft of 10%, 10.06 after adjusting for company specific risks. Their current trailing or expected dividend is 0.9%. As we talked about, they do actually also have buyback authorizations, bringing it up to more like 2.5%. Most recent 5 years back sales, $96.5 billion versus most recent year of 198.2 billion, which comes to sales growth of 15% per year for the last 5 years. Sales capital for the last 5 years on average has been 0.64 compared to the industrial expectations, which, as I said before, isn't really a super comparable estimate for this. I kind of opted for making the beta a more relevant measure than the sales capital and profit margin assumptions for the industry. But either way, they have a much lower number than that and a much higher margins, which is kind of in line with the general pattern we usually see. Returns on invested capital for the last 3 years on average, or wait, it was a 5-year average actually, has been 20.7%. Debt to equity ratio currently under 3%, and no default risk really to speak of because they just have so much cash on hand that they can pay for it. Pretty incredible that second best case scenario is close to the current price, and that's assuming a 40% margin in perpetuity. Sure is. It sure is, but that's what their most recent margin is. Adjusted margin, of course. Again, we're using the R&D adjusted margin, so it's not GAAP. Like GAAP, it might be more like 35, you know, 36, 37, something like that. But I mean, that's basically just, it's like the market looking at the most recent margin and just assuming it's going to go forever. That makes sense. I mean, it doesn't actually make sense, but that's what the market likes to do. You know, like that's what the market often does, is what most recently happened is going to happen forever. So I mean, yeah, that checks out in my mind. And then that's also kind of them seeing the most recent growth rates as well. It's like the most recent growth rates, the most recent profit margins. The part that doesn't make sense is the sales to capital ratio. It's like I said, like I'm actually allowing that sales to capital ratio to kind of make its way through, but compared to their last 5 and 10 years worth of their sales to capital ratio history, that part doesn't really make sense. But the based off of the revenue growth and the margins of that fourth model, Yeah, I can see why the market is kind of pricing it the way it is, sort of. Which, admittedly, the market tends to disagree about how to deal with capital expenditures a lot more than margins. So that makes sense as well. That maybe they're not looking at the way I look at margins. I think it's tough to even value these mega caps considering all the money that freely flows in them, regardless of valuation. Well, what does that have to do with valuing them? That has to do with buying them and holding them, maybe. But that doesn't have anything to do with valuing them. The fact that ETFs are fund flowing their way into the mega caps like crazy doesn't change the cash flows that the business itself is going to earn. You know, so it's like that just tells me that those fund flows are just settling for lower and lower yields moving forward. It doesn't actually change the value that the company itself is going to provide. So no, fair, but I would argue that's like if you find yourself like people say stuff like that, and you weren't saying that you needed to do something because of that, but like people say, oh, if somebody says DCF isn't relevant or something because of this or something, then I would let them and says, well, you're just looking for an excuse to invest in a company you shouldn't invest in. Like Microsoft is an amazing company, killer company. Look at this thing. Like it's an amazing profit machine, but I just can't value it. I can't invest in it though because, well, as you said, all the big mutual funds and institutions have been buying this baby up forever. So that's just the way it is. Because they've seemed to be overpriced forever and traditional valuations still rise. But it's worth noting that even with that kind of fund flows, these things can still reverse. I mean, obviously we've done some strong reversals in the last few months. Obviously Microsoft and Apple, for example, have been like the two big dogs that have really resisted a lot of it, but it can keep going. Hey, yeah, GT, throw it out there. But kind of keep trying with this. I kind of set on top of the sales growth. So with the returns on invested capital being about 21%, like I said, the debt to equity ratio being 2 to 3%, the profit margins for the last 5 years have been 33 to 34%, giving them profit in the most recent year of 80.3 billion. Currently trading for $274.82. Yeah, for sure, Meta. If we go the other way and say you already held Microsoft at a cost basis of $170, would you trim based on your model? Usually the only time you can buy megas is when they are hated. Microsoft was like this during the Boomer era. Yeah, absolutely. Ace of Fox. See, it's like even the big dogs will still have some bad moments. Yeah, Meta. I mean, Meta was in the same category of unbuyable a year or two ago. It's not in that category in my opinion now. It's a pretty decent bargain now. Has its problems and has its arguments, but it's in the range where you can argue for valuation, or just hold. And I'm thinking about your question, GT. I'm working on it. I have a suspicion that the sad way this ends is a bloated mega cap being basically owned by mutual funds and ETFs within 401ks going at snail's pace for a very long time. Yes, that's exactly what happens. Absolutely. It's like this is the thing that why one of the reasons why it's worth talking about the institutional holding here. It's like it's great if you can find a company that doesn't have large institutional holding for a variety of reasons. It doesn't already have the fund flows, but that also means that it doesn't have the vast majority of its votes going to basically just a bunch of pensioners, which, nothing wrong with pensioners. They got to do what they got to do. But the point is their incentives aren't the same thing as a value investors, so I mean, these things affect the way the company's going to go. Like I imagine the more institutionally bought a company becomes, I imagine the less pressure there is for CEO change and for other executive changes, which means the company can become worse run. Can is being the key word, not always. So getting to your question, GT, you said 170. If you bought it at a cost basis of 170 based on this model, would you sell? I'd say that it kind of depends on a few other questions, like the remainder of the person's portfolio would matter a lot to this. If it was the person's whole portfolio, like if they were 100% Microsoft, well, then I would say that it depends on opportunity costs. Exactly. Thank you, SFOC. That's exactly the correct answer. It depends on opportunity costs. And which is why it depends on what your rest of your portfolio is. It depends on what your other opportunities are. It depends on how much cash you have on hand and how much you need some cash. It depends on a lot of things. So it would be on the chopping block. That's basically what I would say. It's like any stock that is overvalued is on the chopping block. Whether or not you actually choose to send it there is the question. You don't have to necessarily sell. Like, I've held companies that are overvalued myself when I had a really good cost basis. You have to account for the tax burden. Yeah, see, tax burden. I didn't mention that one. That's another factor. There's a lot of things that go into deciding whether or not to trim a company. Just because it's overvalued isn't necessarily the only reason. It's just a pretty strong reason to be considering those other factors. But like if you have a pretty diversified portfolio, then you could argue about just leaving it there. But if you also have a pretty diverse portfolio of great opportunity companies, you could argue right there for selling it to shift into some of those greater opportunities. So it really comes down to a lot of things. Right on. I was just curious, have you used your model similarly for as signals for both buying and selling? Yeah. So I mean, I guess I basically just answered it. It's like, do I sell based off of these numbers as well? Effectively, but it's like I said, it's not exactly always the same thing. I very much also take the 5-year number into account. For example, like this thing is like I might allow it to go a bit overvalued for a company depending on what it is, but I often find myself regretting doing that sometimes too. So long short, I do some smaller short activities, but I don't short individual stocks, or at least I haven't really done it yet. If I had a larger portfolio, I probably would start getting into that in a limited way. I do have a small percentage of my portfolio short, but it's like based off of it's shorting indexes and shorting macro factors like that for like hedging. So like for example, I am like 5% short right now. I'm like 15% cash, 5% short, and 20% long or so is approximately my portfolio right now. But those short positions are short ETFs or puts on an index. How many companies do you typically have in your portfolio? Right now I have 18, I believe. 18 plus a couple macro positions, which are like ETFs and stuff. Because I find myself holding onto my overvalued stocks more so than I find myself holding back from buying them, just because as Fink said, I sometimes don't think I have another stock I'd like to put in. Yeah, no, I mean, like that's always what it comes down to. It's like I've talked about this before. It's like I buy and I sell kind of independently. I buy all the time. We're getting into strategy. I still haven't really given the full overview of this, but this is a really good discussion. So I'm always good when we get a nice discussion like this going. My personal strategy, like I don't talk about these aspects much. I basically just talk about valuation most of the time, but like, and I've talked about it a bit in the Discord bit, but like my strategy as far as buying and selling goes, I like to buy all the time, because I definitely agree with the whole notion, like you don't know when the best days in the market are going to be and all that jazz, right? So I buy every week, I buy every Monday, and that's when I buy. And Mondays, just because it's the beginning of the week, and I like to have fresh information from the weekend. So Monday morning I buy, and that's when I buy. And then I also like to double down on my Monday buy if the market's down, and then I'll just leave it be if the market's up. So I kind of try to like tailor into buying a little bit more when the market's down by doing that, but I try to systematically be buying all the time. Now, when I'm selling, that's the thing that comes into question. I don't sell all the time. I sell when a position is overvalued. I sell when I don't have enough cash on hand, which I use valuing the S&P 500 and a few other like methodologies to try to come up with a percentage target. I have a cash target and I have a cash allocation. And so if my cash allocation isn't large enough compared to my cash target, well, then I need to think about selling something. And even if that means selling a stock that I kind of like, well, then I need to trim it a little bit, because I need to have my cash target. And if I don't have enough cash target, if my cash isn't large enough, well, then I need to build it up there. But if my cash target's large enough and I like my positions, well, then I might not sell, that's where it comes down to. And then I might sell a stock that, it hasn't even gone anywhere yet. I might sell a stock that's down. I might sell, it doesn't really matter. It just comes down to which is the best opportunity. You have to kind of always weigh these things. I mean, I talked about it at the start of the stream a little bit. I guess I'll kind of diverge from it a little bit more. I talked about at the start of the stream that I bought a little bit of Interfor this week, and Buckle and Smith & Wesson. Those were the buys, but I also trimmed some stuff too. And so I had been talking about trimming Alibaba and Biogen lately. I didn't trim any more Alibaba this week, but I actually cut Biogen from the portfolio. I think it has potential to go back up in a variety of ways. I think some of its newer drug opportunities are better than the other drug opportunities that I was valued on, but my original thesis was wrong on that one. The opportunity cost and other things were better. I needed cash on hand, so I sold Biogen. Just had to say that, okay, that's the one we're getting out of. Like I said, Alibaba I've trimmed. I might get rid of all of Alibaba if other opportunities keep showing up, because right now I do have other opportunities that are better than Alibaba. So that's the deal. Valvoline, that's another one. Like I said, I'm going to go watch their quarterly call right here. That one's basically gone nowhere from my cost basis so far. But with the rediscounting, I've decided that that opportunity isn't as great as I otherwise thought it could have been, and I'd much rather put it in better opportunities, like the top of the list up here. So it's like there's always there's an ebb and flow to kind of like what you move into, and you kind of got to be careful about doing it, because you want to move into the best opportunities, but you also want to give stocks enough time that they actually have the opportunity to do their own investment. If you're forever moving from one opportunity to another, you could always just keep incurring losses and theoretically keep finding a better opportunity while never actually going anywhere. So you want to be careful about doing that, and not just like be super quick to hop into it. I try to have reasons to believe that my original thesis was wrong, or it was deteriorating, or things like that. There's got to be some logic to why you're hopping away from it. But yeah, it's a whole lot of factors that kind of go into these things. And then I've talked about this valuation score that I have, that I use for valuing companies. That's partially how I figure out how much of each stock I want to own, is based off of that, which that's a whole thing that I'd have to get into. It's a whole complicated thing that I can't really explain super easily, because it's just like a spreadsheet calculation that I came up with for my own portfolio. But yeah, so I mean, buying and selling companies, you kind of have to make calls one way or the other in pretty complicated ways, based off of all the opportunities in front of you, but also taking into account future possible opportunities, which is why the cash position is important. It's like the cash position I have to have basically at all times, because I never know when the market's going to take another dive. And that technically there's an opportunity cost to holding that cash as well. Nice to see you, GTX there. I own the preferred. See, that's one that I had done a valuation on, and I had kind of gotten a little optimistic on the common shares before fully understanding all of the share dynamics. I wish I had gotten in on the preferred at a pretty decent cost. There looked like there would be some better opportunity in the preferred shares than for the common. But that's another opportunity, because like I'm not afraid to start a position and then move out of it quickly after I've learned a little bit more about the company, because sometimes starting a position is a good way for me to like convince myself to learn more, which means that sometimes I end up sacrificing small amounts of money by doing that. But that's why I diversify pretty well too. But the GTX one could be very, very interesting. This the valuation I had for the common isn't looking so hot, but like I said, the preferred structuring for that could definitely be a lot more optimistic. But anyway, getting back to the valuation at hand here, I did kind of finish the past data, but we'll get into the actual future projections. The probability distribution that I'm using for the stock is weighed pretty heavily into the third model, but also weighed a little bit more optimistically into the fourth model. The revenue distribution, I have a worst case scenario of 233.7 billion. In the best case scenario, I have 680.1 billion. On expected basis, I have 436.2 billion. So which comes to anywhere from 3 to 28% sales growth on a compounded basis per year. On expected basis, we see 17% per year. So I'm assuming that they're going to accelerate their sales growth. That's a pretty optimistic assumption to have. Sales to capital ratio going from 0.64 to 0.84. That means I'm assuming that they're going to have a much cheaper amount of capital in order to achieve these higher revenue growth. So higher revenue growths and cheaper capital in order to achieve it. It's going to push the returns on invested capital from 20% up to 29% on an expected basis, which is also on the back of the profit margin distribution of anywhere from 15% to 50%. On expected basis, we see 35%. So the profit margins for the last 5 years average about 33%. We're seeing it pushing up to 35%. The sales capital ratio is pushing up from 64 to 0.84, and the sales growth is pushing up from 15 to 17. So super optimistic on basically every fundamental metric, and we end up with an expected profit of 153.9 billion, and that gets me still, with the discount rate that I've used, $197.21. The CHRS valuation gets validated tomorrow. Oh yeah, you're very curious about that one. Definitely, that's another one. You know, another one that kind of took a position on that one, decided that I didn't like it and hopped out of it. Took a loss on that one, but that one was also a much smaller position. But got some revisions in my thinking around that one as time moved on. But yeah, so you can see with the discount at 197.21 cents, that puts them at 28% overvalued. The 5-year forward value targets, unadjusted for the dividends that they'll pay out. Worst case scenario, $138.82. Best case scenario, $646.07. On an expected basis, I see $318.49. Compared to the current share price, that gets us an implied return of just under 3% per year for the next 5 years. So yeah, super low expected returns for Microsoft, in my opinion. Are you aware of the hearing tomorrow and it's up like 35% in a week? No, I'm not paying any attention to that. I got rid of that stock much earlier in the year. I basically decided, I was like, you know what, I need to stop dealing with a lot of these biogen stuff. I don't know the industry nearly as well. Unless I have very specific key information about a particular drug, I'm gonna try to steer a little bit more clear of that industry. I've been burned a few times on that one, but I need to focus more. It was a company whose revenues were all focused in the future, and that's another thing where it's like most of the stocks that I was holding that had large revenues forward out in the future, those are the companies that have done the worst in my portfolio. And I've definitely decided that I was like, you know what, I need to stop trying to focus more on those kind of growth companies and focus a little bit more on what I know I'm better at, which is more typical valuations and stuff. But you know, just speaking super honestly about it, it's like companies like Corsair and like I said, Biogen. It's another one with the revenue super far out in the future. Alibaba, all the more growth focused companies, those are the ones that have been eviscerated. And Coherus is in that kind of same vein, where it's all based off of the potentiality for future revenues, and so they've been cut down pretty dramatically. Let's see, there. Pull them open. Yeah, so I'm saying they were 721, trading for 10 now. So I'd say they're trading a year or two up, but they also could just be trading on one of the more optimistic cases. Where's the fundamental metrics I had for that case? 1.1 billion in the 5-year forward period. I don't know. Yeah, I haven't been paying attention to them for the last like 6 months or so, so I don't know what's going on with any announcements that they have in the near future. But maybe I'll take a look at them after the stream. But yeah, so that's pretty much gonna do it for Microsoft today. I do think that the next stream I'm going to be doing is BBWI. I have that one basically ready to go. Also finally got some time off of work, so I'm working on getting a few more evaluations in ahead of time. People who join the Discord can try giving some suggestions for other companies to do in the future. So please give us a like if you've watched up to this point. And if you're not already subscribed to the channel, please subscribe to the channel and join the Discord. The link is in the description below. I'll catch you all again next time.